$4.6 billion. Literally just gone, evaporated in a matter of weeks. Now, you might be thinking the guys who lost this astronomical sum back in 1998 were reckless gamblers, right? No, they were literally Nobel Prize-winning economists. They built these wildly complex mathematical models, used massive leverage to try and outsmart the financial markets, and it completely blew up in their faces. Meanwhile, a few states away, a guy named Warren Buffett was getting obscenely wealthy just buying boring companies and, by his own admission, taking a lot of naps. It's a pretty stunning contrast, isn't it? The smartest guys in the room nearly dragged the entire global financial system into a black hole, while the patient, boring investor became one of the richest human beings in history. All right, so let's dive right into this explainer and cut through all the noise out there. We're going to uncover the 10 most catastrophic financial mistakes that absolutely crush beginner investors. Seriously, these are the hidden wealth killers that blow up smart people's money in every single generation. And we'll go over exactly how you can avoid them so you can build lasting, bulletproof wealth. To make this super actionable for you, we're going to group these 10 hidden wealth killers into 3 main pillars of investing. Number 1, building your financial foundation. Number 2, avoiding strategic portfolio pitfalls. And number 3, mastering the investor mindset. So, let's start right off with pillar 1, building your financial foundation. Basically, these are the absolute prerequisites for wealth that you need to have in check before you even think about truly entering the market. Our first 2 massive mistakes are hiding your money in cash and completely ignoring the silent tax of inflation. A lot of beginners think keeping their cash stuffed in a traditional savings account is the safest move. But actually, cash isn't safe at all. It is mathematically guaranteed to lose its buying power over time. Think about it. If inflation runs at a totally normal 3%, a dollar loses almost half its buying power over 20 years. So you aren't protecting your money by holding cash, you're literally just watching it slowly bleed out while, patting yourself on the back for being responsible. To beat this, you absolutely must shift your focus toward investing for long-term compounding wealth. And that brings us to mistake number 3. And honestly, the sheer mathematical cost of this one is staggering, not starting early. People always say, oh, I'll just wait until I have more money in my 30s or 40s to start. But thanks to the magic of compound interest, an investment of just one single dollar at age 20 is worth roughly 4 times more than that exact same dollar invested at age 40 by the time you hit 60. You literally have to work 4 times harder and invest 4 times the cash later in life just to match what a tiny early start could have done for you. Time is the one ingredient you just can't buy more of later. So the crucial takeaway here is avoiding mistake number 4, which is lacking an emergency fund. Before you start pouring every spare dime into the stock market, you absolutely need 3 to 6 months of living expenses sitting safely in a high-yield savings account. Why? Because life happens, right? Cars break down, unexpected health issues pop up, people lose their jobs. If you don't have that cash reserve ready, you'll be forced to liquidate your stocks just to pay your bills. And invariably, emergencies seem to hit when the economy is already struggling, which means you're going to be forced to sell your stocks at the absolute worst possible time, locking in massive losses. Let's move into pillar 2, avoiding strategic portfolio pitfalls. This is where we look at the actual mechanics of investing, moving from basic saving to constructing a really bulletproof portfolio. Mistake number 5 is paying high fees. A 2% management fee might sound harmless, but it completely ruins your future. It acts like a silent roommate who pays no rent, never does the dishes, but over 30 years just strolls out the door with 43% of your entire portfolio. And the crazy part? You'll never get a bill in the mail for this. It's just quietly skimmed right off the top. When you compare expensive actively managed funds to simple, low-cost index funds, those fees almost always swallow up any quote-unquote expert advantage. Do not give away half your retirement to a silent roommate. Mistake 6 is using leverage. Remember our brilliant Nobel laureates from earlier? Yeah, this is exactly how they lost $4.6 billion. Leverage is when you borrow money from a broker to invest. Now, sure, it feels incredibly powerful when the market is going up, but it completely saws off your financial floor during a dip. If you're leveraged, a totally normal 25% market correction won't just put a dent in your portfolio, it will cause a total unrecoverable wipeout through a margin call. It literally forces you to sell at the absolute bottom. Then we have mistake 7, poor diversification. We all know the saying, right? Don't put all your eggs in one basket. No matter how much you love a company, it's a huge risk. Take the infamous case of Enron. It was seen as this massive, highly reputable company, and a lot of employees had their entire life savings and 401ks tied up solely in Enron stock. Well, when it was exposed as a massive fraud and went to zero, those people lost literally everything. Broad, low-cost index funds spread your risk out across hundreds of companies, saving you from that kind of catastrophic single-point failure. Mistake 8 is ignoring tax-advantaged accounts. If you're sticking purely to standard taxable accounts, you are leaving an unbelievable amount of wealth on the table. Utilizing a Roth IRA means your money grows entirely tax-free and you pay zero taxes when you pull it out in retirement. Plus, if you're ignoring your employer's 401k match, you are literally declining guaranteed zero-risk free money. I mean, always take the match. Use these accounts to legally shield your wealth from the tax man. And finally, we arrive at Pillar 3, mastering the investor mindset. This is the psychological warfare of investing. Because, honestly, the math is easy. It's the psychology that destroys people. Mistake 9 is trying to time the market. People love to think they can predict the crashes, jump out into cash, and magically jump back in at the absolute bottom. But the data coldly proves that you can't. Over a 20-year period, if you try to time the market and miss just the 10 best trading days out of thousands, your overall returns plummet by 67%. No way, right? And here is the cruelest joke. The absolute best days in the market almost always happen within days of the absolute worst drops. So if you run for the exit during a panic, you miss the explosive rebound. Which feeds directly into mistake 10, the rapid-fire emotional trading traps that just destroy beginner portfolios. We're talking about panic selling the minute you see red instead of treating a market dip like a Black Friday sale. It's treating the market like a casino with rapid-fire day trading, which pretty much guarantees you'll lose to institutional algorithms. It's letting your ego force you to hold on to dying, failing companies because you refuse to admit you made a mistake. And incredibly, it's selling your compounding winners too early just because you want to lock in a tiny profit, totally amputating your portfolio's future growth. Now, a massive part of this emotional trap is blindly copying the stock picks of your friends, influencers, or internet message boards. If you invest in something you don't genuinely understand just because it's popular at the moment, you have absolutely zero conviction. You won't know when to get in, you definitely won't know when to exit, and you'll panic at the first sign of trouble. What might be fun play money for a friend's wild crypto bet could be your entire life savings. Your age, your goals, and your unique risk tolerance are yours alone. You gotta do your own independent research. To avoid getting swept up in all that market hysteria, you really have to understand the core difference between price and value. The price is just a flashing number on a screen. It's wildly driven day to day by the fear and the hype of the crowd. Value, on the other hand, is what the underlying business is actually worth based on the real cash it generates. If a genuinely great business drops in price because the crowd is panicking, the value hasn't actually changed. It's just on sale. Beginners stare at the price, wealthy investors focus on the value. Everything we've talked about today really just boils down to one simple truth, perfectly captured by Warren Buffett. He reminds us that successful investing isn't about having a genius-level IQ. It's not about outsmarting the market with hyperactive trading. It's simply about outlasting the impatient crowd. It is about quietly riding out those boring, flat years, turning off the noise, and just letting compound interest do the heavy lifting over decades. So I'm going to leave you with this provocative question to chew on. What if just one of these hidden mistakes, a 2% fee, skipping the emergency fund, or that urge to try and time the market, is quietly eating half of your future retirement right now? Audit your own financial foundation today. Take a really deep look at your portfolio, because your future self is entirely depending on the choices you make right after this explainer ends.